Hi, today we will discuss new no-loss strategy that is being used by hedge funds, institutional investors, and really high net worth investors. This is a strategy that others like you, the common investor, doesn't even know, whereas all the major investors knows this new no-loss strategy. Now we will discuss how to make winning trades. Now, to discuss winning trades, we will discuss different scenarios only for call options. Now, to explain you further, we will discuss a fictional company so that we can explain you all the points that goes into preparation or the different parts that makes this option trading works for you. So let's discuss. Let's say you want to buy a fictional company, ST company at $55 and want to secure your trade through options. Now, if you buy 100 shares at 55, so it comes to $5,500. If you buy it right now, you need to put $5,500 into your brokerage account and then you will be buying this share. Whereas in a call option, this is not the requirement. Let's discuss it further. Let's say that on May 1, the stock price of ST company is $55. And to buy this call option, you need to pay a premium, that is $3 per share. So the total amount per share comes to $58. And as you are like paying a premium, so the expiration date for this call option is 4th Friday of July. So as we are discussing May 1, that means the first month is June 1, the second month is July 1, and then the third month, that is the July month end, is the 4th Friday. So basically you are getting 3 months in which you will have a kind of a trade which will not require huge amount to be invested and will have a loss that is fixed. So if your research is correct, you will only make money, and even if it goes against you, you will not be losing a whole amount of money, only a small chunk of it. So as we discussed, your cost comes to $58 and currently the company is trading at 55. So you might be thinking, what is the total amount that you need to pay? The total price of the contract is calculated as $3 per 100 shares. One contract of call option is 100 shares. So if you buy one contract, you are basically saying that you are buying 100 shares. So $3 multiplied by 100 shares comes to $300. So your cost is $300. Now let's say as per your research, the earning report of this share comes exactly what you predicted. Now as the earning report comes really good, your stock price rallies. It goes to $65. So the initial rate was $55, it goes to $65. So it's a $10 profit. Now in a $10 profit and one call option is 100 shares. So 100 shares multiplied by $10 profit makes it a $1,000 profit. But remember, you have paid $300 premium initially. So that $1,000 minus $300 makes you $700. So in the end, you made $700. But you need to remember, you only invested $300 and got a simple $700 initial profit without doing anything. You didn't bought the share at $5,500 just to buy and hold that stock. You simply put up a call option that is an option of $300 initial payment. That's it. And if it goes according to your plan, you made $700 initial profit, which is 2.25% of your initial investment, that is $300. So the profit is exuberant. It is brilliant. But your loss is stop loss. That is only $300. It cannot go lower. The stop loss market can open lower. Your stop loss might not be hit. But here, you know that $300 cannot increase. Brokerage fees will be applied, but $300 will stay the same. So this is one scenario. Now you might what you predicted that the result will come good might have gone the other way, and the result would have been really bad. Now that bad earning report would have caused stock price to fall. It could have gone from 55 to $30 a share. But in this case, you would have the option to let the call option expire worthless. So the total loss comes to only $300 that you paid at the time of the purchase of the option. That's it. And you get 3 months, total 3 months, to see if the stock goes to your side or not. And the best part is, let's say it starts up, it goes to 60 and then falls to 55, again goes to 58, falls to 56. But in the first run, when it goes to 60, you can simply buy another option that would cancel both options. Now you have bought a call option. If you buy a sell off call option, if you buy a put option, the both will be squared. So basically, you can lock your profit at any time you want. If you need, I can explain this in one-to-one session. That is, if you want, I can explain it on the chat or Udemy chat portion. Now let's discuss the second scenario. Say if you own $50 stock and you collect $1.50 for selling $52 call option that expires in 60 days. So you would be picking up 3% profit just in a snap without risking much. I will discuss the risk parameters so that you should know which stocks you need to buy so that your risk is always reduced. Now, how this 3% is calculated is $50, $1.5 divided by $50. Now, $1.5 is 3% of the $50. If that option expires worthless in 2 months, so your annualized rate of return is 18%. That is, it's 3% in 3 months, 6%, in 3% in 2 months. In 4 months it goes to 6, and 6 months it goes to 9, and so 12 months it goes to 18%. So you multiply 2 months by 6 to figure out what you could earn from doing that same trade again and again for 1 year. Now on good stocks in volatile market, you get premiums on call options as well. So it's the profit that is locked and there is not much risk in it. Now in this scenario, you need to own the $50 stock. So 100 share of a $50 stock comes to $5,000. But the point is your earning percentage. You're always earning through it. Now you need to buy good dividend stocks. Dividend stocks you need to buy. But a good dividend stock usually stays the same. Doesn't rise that much and it doesn't fall that much because let's say a $50 stock gives you a dividend of 3% a year. If the stock goes to $100, that 3% dividend goes to 1.5% dividend. So the dividend percentage falls and that could make it not a healthy stock. And the same way if the $50 stocks goes down say to $40, so that same 3% dividend yield increases to 3.33% because of the $10 fall in the stock. We will discuss it further in the next chapter. Thank you.